Let's make it. Greetings and salutations, good people.
Yup.
Welcome back to another episode of Market Mondays.
So now we back to where we never left.
Legendary vibes. You know how we do. It's gonna be a big one. Big show today. Big show. Let everybody pile in. Shout out to everybody out there all over the world.
The team here.
Shout out to YouTube. Shout out to EYL University.
Shout out to the earners.
Yeah, this is a big one, man. We got
We're looking clean on there. Shout out to YouTube. They got us looking clean.
we got a special guest. We have
Pop, what up?
of course Mr. Ian Dunlap back, and it's going to be something special. So let's get right into it. This is a big week for Earn Your Leisure. We have none other. Is Ian on yet?
Yeah, he did.
We have none other than the legendary Killer Mike will be our guest tomorrow for the show. What's going on, brother?
Happy Monday. Thank God it's Monday. Y'all looking sharp, man.
They got us looking clean, right? They must have
Yeah.
4K on YouTube.
Yeah, man. Just trying to make it out here, man. Just trying to make it.
I'm gonna have to get all my hoodie and jogging pants orders in.
Yeah. That's on the way.
Yeah, man.
That's on the
We
way.
got the merch. You got the merch. Shout out to everybody out there showing love on the merch. Yeah, that's something that we working hard on, and we gonna release some new things coming real soon. So yeah, just to give you a quick rundown of our week, is crazy. We got Killer Mike tomorrow. That's a dope episode.
It's gonna be legendary.
Yeah, legendary situation for sure. Shout out to Killer Mike. Shout out to everybody at the
Shout out
swag.
to Edgewood, man.
Shout out to Edgewood, man.
Yo, if you from Atlanta, man, you know that. Edgewood, the legendary, historic Edgewood, man. We was out there.
Yeah,
Interesting.
that's interesting.
I said, yo, Shawty, park the car. He said, yo, come with me. I said, all right, man, I got you.
Edgewood after
It's
dark.
different.
We go anywhere for an interview, man.
We'll
Different.
Yeah, we'll go anywhere. We travel, man. The equipment travel too. So
Yeah, shout out to everybody in Swag Barbershop. We got that done. That was really dope for us. And shout out to Killer Mike, man. Just a really authentic, good dude, man. Solid dude. Shout out to his wife. She came through also at the end. Killer Mike, man, very smart guy. So
yeah, man, historian. That dude is a historian. Like that dude is literally like an encyclopedia when it comes to the information, man. Especially when it comes to the city of Atlanta and the state of Georgia, man. He's the go-to guy if you need to know.
He loves Atlanta.
Oh my gosh.
Yeah. Legendary family too.
Yeah, man. Like he said, he's been an activist since he was 15 years old. And like when you hear him speaking, when y'all hear the interview, it'll be very evident that he's 100% authentic about that.
he's the real deal, man. So shout out to Killer Mike. So that's tomorrow. And then we also have a legendary in his own right,
Yeah, that's a fact.
Chris Senegal from your neck of the woods, Houston, Texas.
Legend.
He's doing an open. So once a month we do, like every last Wednesday in the month, we do an open enrollment EYL University class, which is open to the public. And that's on Wednesday at 8:00 Eastern Standard Time. He's going to give a presentation, teach a class about how to buy back the block. Everybody says that it's real trendy, but he's actually has done that in the Fifth Ward in Houston. It's like, Jay Prince, and then he's right there.
Yeah, man. Yeah, we
Legendary.
seen it firsthand. Like this dude literally bought the block. Shout out to the Fifth Ward.
So that'll be on YouTube at 8:00 on Wednesday. Make sure y'all check that out. And we're gonna get into it. We got dope guests. Bonawyn Eison. So this is the first time that we've done anything with somebody from CNBC. If anybody watches, you obviously know that we're all real big fans of CNBC. I've been watching CNBC for years. I follow their Instagram page. They got a lot of dope content. So Bonawyn is a contributor. He's a contributor to Fast Money, one of the most popular shows on CNBC, and he's also a managing director of equity derivatives at XP Investments. So we'll have a long conversation with him, but I'm excited about having that conversation and bridging that gap with CNBC and with him and I'm sure it's going to be a legendary conversation. So
Yeah.
before we bring him on,
Kudos to the CNBC family and everybody at NBC Universal.
Hey, fellas. Hey, good
Hello.
people. How you doing?
So Ian, man, what's going on, brother?
I'm good. Happy to be here. I'm very excited about tonight because I don't think they know how long he's been on CNBC. I think it's been 9 or 10 years. So I'm going to be in full Tavis, Oprah mode tonight. So everybody in Zoom,
YouTube,
I may get about 12 or 13 off, so don't kill me. But I promise I'll ask some good questions to give you guys some good answers, especially since we dropped hard today, which I said we would 2 weeks ago.
That's a fact.
But yeah, I'm happy to be here. I think today's show is going to be record breaking.
And it's a big week too. It's a big
Yeah.
week. It's a big week in the stock market. We got our big fangs reporting this week, so that's always an interesting time.
Yeah, for sure. So Troy, you want to go over the disclaimer?
Yeah. And we spoke about this yesterday, actually, in our book club. Shout out to all the earners that were in the book club. We started Money Master the Game. Do your own research, please. Do your own homework. That is so vitally important. Our content is intended to be used and must be used for informational purposes only. It's very important to do your own analysis before making any investment based on your own personal circumstances. You should take independent financial advice from a professional in connection with or independently research, verify any information that you find on our show and wish to rely upon, whether for the purpose of making an investment decision or otherwise. This message is brought to you by the good folks at Earn Your Leisure.
Yeah, for sure. And shout out to Weezy and shout out to Drake on the album covers.
Oh yeah, it was a cat. It was in a cat. It was his birthday.
Young
the other
Money.
day.
Yeah, shout
out
out
to the great one.
Changed the game a whole lot.
Yeah, that's a fact.
So yeah, let's get into it. Let's get into it. Ian, let's jump right into it.
Let me share, and I promise I won't kill Zoom.
All right.
Moving slow on the mouse. Everybody on YouTube, what up? I love you guys. Shout out to the Red Panda family. You guys are absolutely amazing. All right, let's go. Let me know if you guys can see my screen, then I'll start.
We got you.
We got you,
bro.
Okay, perfect. So of course we had a drop today, and I want to give you some context of where we are right now in terms of the market cycle that we are going through. It's fun when the market is going up, but when it slides down, everyone's like, oh my God, I hate this part of investing, but it is a part of the game that we all are going to go through. So I want to give you some context. So where exactly are we? The thing I need you to take away from today is I don't want you to confuse a bad week or a bad day in the market with an actual bad performing market. We're really just coming off highs. But of course, COVID is kicking back up. Election concerns are right around the corner. We're not exactly sure who's going to be our leader. And that is making the market a little bit timid. And that's the part of the reason why we slid down today and why I said 2 weeks ago, we were going to come down. These are the levels that I'm watching. So for everyone watching at home, please get out your camera and screenshot this. As long as the S&P future stays between 3205.50 to 3397, kudos to Kayla. Happy anniversary to you. Dow, as long as the Dow stays above 26,500, and as long as the NASDAQ future stays above 10,624.75 to 11,544.75, we are okay. Somebody just said it in YouTube. 5 to 10 years from now, we will not care about any of this. But if the Dow drops below 3205.50, that's when I'm going to say, okay, we may be in for a wild ride. So if you guys have that, screenshot it. I'll go to the next slide and just say yes for me in chat. But these are the key levels to watch. And for those of you on E-Trade, TD Ameritrade, please set an alert here. So if we fall below, you know that some of the stocks that we've been waiting to load the boat on will be on sale. For my new investors, this is a key lesson. The market will not run up indefinitely to the upside. I know it was fun in April and May, and I know it was fun in August when the market was running like crazy, but this is the after effect. When things are not certain, when the economy is not strong. So the stock market has done great, but the economy is not doing well. The slide begins to happen. For all my traders, now you have to start to look to short a little bit more as well. So the market will in time go back up, but every single week is not going to go up week after week. And if we crash before the end of the year, what should we do? We should recover in the first quarter of 2021. So I'm going to give you some dates and give you some facts to tell you when this has happened. So in 1987, 1990, October of 1999, the market fell apart in the last quarter of the year and then recovered the following year. This also happened in the end of 2015, the end of 2016, and it was really scary in 2018 when we had a sharp dip, and then January of 2019 came around and we ran off to the upside, and it was quite amazing. So for those of you that are new, that are experiencing this for the first time, the ride will be rough for a couple of weeks, and then after that, everything will smooth out for us. When have we not recovered? So I want to give you context for that as well. So when you tie in the dot-com crash of 2000 paired with the tragedy that happened of 2011, that's when we did not recover in the first quarter of the new year. And then also in a Great Recession. I think there's enough historians and documentaries about that, about why we did not recover. But those are the only two instances in modern history where if we drop a lot in fourth quarter, that we won't recover in the first quarter of the next year. So typically, with a question that people have, how do I feel about gold? Gold is good, but gold, as we talked about, has been running up with the rest of the market. So it's too high. You can look at the ticker GLD, which is the most popular ETF tied to gold. Gold is going to slide down as well. The bond market is a good hedge, even though we'll talk about it later. And I'll let Rashad Troy and our special guest talk about the bond market as well. But the bond market was too high as well. The only true inverted correlation with the market is the VIX. So I'll save the answer for that later. But gold is a good hedge. Thank you for this question. What do you do when you buy low? This is a great question, but you want to buy more, or you buy more and your average price keeps increasing. There's only one or two things you can do. You can dollar cost average, and you are going to see your average share price increase, or you can completely just load the boat, wait for one particular area, and only buy if it gets to that spot. Now, if you have the ability to buy 2,000, 1,000 shares, 3,000 shares, it would be great to load the boat. I know Trapper waited for Chipotle, as he calls it, for I think 3 years to get to a spot. And that's fine. If you have enough capital, you can wait for the market to drop to an exact area. What happens a lot of times is when people do this, you end up missing the mark, or it's short, or when it gets to your level, you're afraid because now it's dropped 15%, 20%, and now you think that it's going to bleed down 10% more. You don't do it, and what happens? 4 years later, you're like, man, I was waiting for the stock at 220. Now it's at 600. So if you have the discipline to wait for one spot, great, but there's nothing wrong with dollar cost averaging because it's better to be in the move than not. What are my thoughts on robo-advisors? I think they're great. We talked about this before with Vanguard. I think the most important thing is to make sure you're getting into good indexes or good ETFs that have low expense ratios. Don't buy into the hype of any particular company. Just make sure to do your research. And for those of you in Canada, you guys can look into Wealthsimple. They have some good options for you, but robo-advisors are very good if you select the right things. Another amazing question that I received this week: with uncertainty in the housing market due to lack of stimulus and homeowners heading into foreclosure, do I see this affecting home builders and retail short-term or long-term? The housing market is so hot. I don't see any issues of a housing crash anytime soon. Commercial is going to be the thing that I'm worried about. For anyone with properties, they will tell you this is one of the greatest markets that we've seen. And because people are moving out of urban areas and going and back into the suburbs, there's not enough inventory. So even with the housing market being the way that it is and the stimulus market not being here, there are people, this feels like 2007 all over again with some of the hype in some of these cities, Houston and Atlanta being one of them. So I don't think that the housing market will be greatly affected. It would do the exact opposite as it has been doing. What are my thoughts on compound interest? I think we all have heard the quote that compound interest is the eighth wonder of the world, but I think one of the things that we neglect to talk about is compound interest on the negative side. So this is why you'll hear us scream not to buy bad companies, because let's say if you're averaging a negative 12 to 25%, let's just say negative 12%. What is the compound interest if you do that for 3 or 4 years in bad companies? Now, for those of us that have traded, we all know we can draw down negative 12% in a week, a quarter, sometimes in a day. But I think compound interest is great. We all have heard of the rule of 72. If you haven't, let that be your first homework assignment for tonight, to Google that. But I want us to play defense while the market is falling, so we don't have compound interest working against us. And what's the best place to learn about different sectors? We talked about that before, but here's some homework for you. There are 11 key sectors. The homework item that I want you to do is from, in numerical order, I want you to tell me which sectors have performed the best over the last 20 years. So this is the part of where everyone says, hey, I want you to teach me how to fish. This is our first lesson for tonight, where you have to get into the boat and cast your rod. Should I focus on quarterly goals? No. I know earnings are very popular. It provides some volatility, but I think one of the biggest mistakes that corporations have made, and they have to play this earnings game, but I think it stifles innovation, because when you're trying to keep up with your competition on a quarter by quarter basis, I think it leads you to make some decisions that you would not make if you had a year or two to flesh out a full idea. So for all of you that are looking month to month or quarter to quarter, it's not the best judge. That's why I tell you the first metric, if you have a good company, is you should be looking 5 years out to see what the potential return could be. Thoughts on Sunoco? So I can't, tell you what to do, but and it happened today, I want you guys, please type this in chat, 10 years. Anytime that you want to get the perspective on if a company is doing well, look back 10 years. Sun is not doing well and has not done well. So if I look at the chart real quick, let me type it in, and we go and look back over time, we can see, and I'll just do 20 years really quick and pull it up. The high for that company was $59.99 back in 2014, and it's now at $25. Is that an asset that you will want to hold in your portfolio? Put yes or no. I want my assets to rise over time. And it's interesting, like, we will hate something that gains 7 to 12% per year, but if something's down 30% or 40%, we think it's a good investment. Good company, just not a great stock to invest in. And we'll talk about this with our amazing guest tonight about what do we think about what will happen after the election. I know these next 2 weeks will be scary, but if we look at history tells us what happens after an election. For those of you that are voting for Biden, Democrats have historically done well in the stock market. Barack Obama, Bill Clinton being two prominent examples, although the taxes are dramatically high. Shout out to 50. I don't agree with what you said, but shout out to you.
You reverse the course on that.
Yes. Well, thank God, 50, because those stars subscription was going to get canceled. So, and then under Republican leadership, there's usually a spike, and then we settle back and we end up in either a recession or we have like an economic pullback. And there are pros and cons to both. But I want you guys to historically look, and let's take the political WWE stuff away. Just look at the numbers. Look and see what happens when each person is under administration and how it affects the market. But I think after election is settled and into the next year, even though the economy won't be the best because of COVID, and then we'll do a smaller version of shutdowns, not at mass scale how we did in March and April, the stock market will do well. I know you guys have asked me a lot about trading plans, but since we have a great guest tonight, I'll wait until next week to cover that. And I want to highlight this. So real estate, the retail investors pushed the market up after stimulus because a lot of us that missed out on 2008 and 2009 did not want this opportunity to pass. For those of you that are new, and for our first time listeners, I appreciate you. But what I want to make sure I deliver to you tonight is that your chance to get into the market will not pass. The great thing for you is that since the market is at a high and it's sliding down, you will have opportunity to get in. All you have to do is wait. I know it can be FOMO inducing to watch CNBC or even watch us and watch everything online. And it's like, man, I missed out. I can't believe I missed out in March. But you will have your chance. I just want you to stay disciplined and wait for your spot, regardless of what you see other people doing. But I want to remind you, The purpose of investing is freedom. Can you guys please put in chat freedom? We'll go back to some of our things that we talked about last week. So I want to ask you guys a couple questions because freedom, it sounds good. And it's a financial freedom and generational wealth is a hot talking point in our community. But I want you to make a decision. Like if tonight, if you had all the money in the world, what would you do with that time that you have? Whatever that is, you need to gear your life to be able to do that. I want you to take a moment to put it in chat. Go ahead.
That's crazy because we literally, this is a conversation that we just had yesterday. It was like, yo, where are we spending our time? And are we overvaluing ourselves, right? Because if we overvalue ourselves, then we're saying that our time is not worth what we're saying it is. And if it isn't, then we need to focus our time on what is going to bring value to us and the people around us. So,
yesterday we're in the book club?
Yeah, everybody in the book club. Yeah, they was going to with that. It was dope. But this is exactly what we were talking about. What's the freedom price? And I think me and G was going back and forth. He was saying, is it a value thing or is it a monetary thing? Which is, I mean, that's up for debate, but like everybody should start having that thing and that kind of mindset. It was like, all right, well, and I used the example of being a teacher. It was like, look, are we going to work to 66 and we're in our 30s? Like that doesn't even sound fathomable to me. And maybe it does to other people, but it just was like, yeah, that sounds crazy to me. And so retirement to me wasn't an age. It was more of like a value. Like what is the value I have to get to in order to retire? Not like, yo, I'm 65 and now I can get, so I'm closer to Social Security and now my pension will be the average of the last 3 years that I worked. And I was just like, yo, that type of game is being played. And it's like, I wanted people to really realize it. So I'm glad that you brought it up because we spoke about freedom and the freedom price as well. So this is dope.
Because if you have all the money in the world and you just sit at home and do nothing, you're going to be bored. I know some people are like, hey, give me the option to do that. But if you've ever been off for a month or two, after 3 weeks, you're bored as hell. If you've been on vacation for 2 weeks, you're like, okay, I need to do something else. So this frames your motivation and helps you define it. So even if you don't know, whatever comes to your mind first, if you were not judged, write that down. Because that's going to push you on the days when it's tough and you don't feel like sticking to a plan. The second question, who would you spend time with? I know a lot of people are going to say kids, family, friends, significant others, spouses, but you have to decide, okay, after I know what I want to do, who are you going to spend your time with? So when we're done with tonight, I want you to go call those people. I don't want us to get so busy that we forget that our family, and that's why I always say on my deathbed, I'm not going to care about any conference call that I miss, any email. I try and pick up the phone every time my mom and dad calls or my friend calls, like, because if something happens. And then being to so many funerals, I've never been at a funeral like, damn, I wish I was on Zoom talking about business. But the people that are most valuable in our life, we often can take for granted for monetary pursuits. I don't want you to make that mistake. So please write down 3 or 4 people that you will want to spend a time with if you have the freedom that you wanted. And this is a question that really gets some clear answers. If you only had 2 years to live, what would you do? Now I know what Mace would do if he had 24 hours to live. I want to know. I want to know what you would do if you only had 2 years to live.
And take a look from my dad that I never knew.
Hey, kudos to Betha.
Shout out to Betha, man.
You have to know this. This will frame what freedom is for. Because getting to a monetary goal alone, okay, great once you get it, but money with no friends, no family, you don't want to turn into Uncle Scrooge. That's not what we're aiming for. And then finally, I posted this earlier on Instagram, but what is your perfect schedule on a day-to-day basis? And kudos to Tiffany. What does your perfect day blueprint look like? Whatever that is, do that. Because some of these things we can start to do now if we choose to. So, and once you map out your life, it's amazing when you start to stick to the schedule, the freedom that you want, and sticking to a plan, some of those dreams that you have begin to manifest. So even like on IG, I know you guys have been asking me about the free futures program. We'll talk about that tonight, but it's not that I am ignoring you. But I want to soak in every moment I can with my family, my brother and Xander, like everyone that I love. So it's not that I'm avoiding you. It's just that I am following my own personal schedule. So I've really been racking my brain, like, why the hell don't people want to stick to an easy plan? I think like indexing or ETFs combined with some of the sectors that we talked about, whether they're consumer discretionary or tech, is like one of the easiest plans. But I've talked to probably 300 people in the last like 20 days about this. And it pairs down to people invest for 3 different reasons, because everyone isn't investing for freedom. Some people are investing for safety. So type in chat if you are investing for safety. You want to put your money into a vehicle in which you do not lose money, or you are doing better than inflation. Bucket 2 is some people are investing for growth or freedom. So you're trying to get to freedom or retirement early, right? And then the third one is one of the most dangerous. Some of us are investing for excitement alone. That's where the overtrading comes from, the overinvesting, having too many companies in a portfolio. And we've all been there. We hear of a hot stock, you know, so a guy decides to take hydrogen and put it into a truck and say that he's going to be the new Elon. And hey, I think this is the one, man. I missed out on Tesla. This one I'm going to ride with. And then it falls apart. So you have to pick out of these 3. Are you investing for safety? Are you investing for growth or freedom? Or are you just investing just to purely be excited? I think there are a lot of other things you can do to have excitement in your life besides investing. Grab your pen and a sheet of paper, or grab your phone. And I want to tell you something that helped me. I talked about my cousin Rick last week. Ariel, how are you? I love you. Tammy, I love you. Kai G, love you. There are 4 key areas in life that we have to focus on. And there are these. So I want you to write down mentally on a scale of 1 to 10, 1 being great, 10 being not so good. How do you feel? Physically, same thing, 1 to 10, how do you feel? Emotionally, 1 to 10, how do you feel? And then spiritually, 1 to 10, how do you feel? And tonight, I want you to make one goal for each of these. So for me, mentally, to meditate and pray every day and then be disconnected from the internet 4 hours a day is key. Physically, you guys already know the working out every day, because if I don't beat this goal by December 24th, I'm after about 2,500 scholarships. So that gives me a good challenge. Emotionally is not to take in any toxic media or have any unpeaceful conversations. And then spiritually, to grow and learn one thing in this area each day so I can become a better person overall. And this is probably going to be my favorite subject of the night, the VIX. I know most people fear the VIX. And when you see it come up on CNBC, you're like, oh my God, the market is falling apart. But the VIX is the easiest way to measure where the market is. And I'm going to give you a key level tonight that will help you. But so if we look at VIX, it's just measuring how afraid people are in the market. The key level that you have to keep your eyes on is $47 for VIX. So we came up a little bit today, but until we get to 47, we're not really in a danger territory. Please write this down and please keep your eyes on this. In the 30s, it's uncomfortable. Great. 47, that's when I'm starting to say, I smell smoke. I think the house is on fire. That's a key level. And then if we look historically, which, you know, I love to go back and look at the entire scope of things. In 2008, it got to 89.53. And then even during the COVID crash, it got to 85. That is the entire block is on fire number. The 80s, that's when everyone is uncomfortable. Even seasoned investors in the 80s are uncomfortable if the VIX is there. But if we break 47, that's when you would need to start to get worried a little bit. And I'll speak this up so we can get our guest on. The owner of the 4% rule. So Rashada talked about this before. Whatever you have in your retirement, you live off 4% a year. The guy that made that famous, he said we should adjust and go to 5% a year. Okay. And then I want you guys to screenshot this and the 6 laws of wealth that you have to follow. Because the thing that I want to give you is all the blueprints that you need and structure so you don't have to think. Because a lot of times on our investing journey, we're searching for the answers, but if we have the answers in front of us, it puts all the accountability on us. So first thing first, I need you to decide how much of your income you're going to save. I'm going to be very honest with you. 10% is not enough. It never has been. So you pick between 20 to 40. 2, invest consistently. So even when the market is bad, you have to continue to invest. We talked about this earlier today, but avoid debt at all costs, because debt is a cancer to your financial freedom. Number 4 is so key. Get rich slowly. I know we all want 40 and 50 and 80% gains, but they don't last always. So invest in businesses that are solid, no matter how tempting the other companies may be, whether it's in the stock market or MLM or other opportunities that you have. Learn something new every day, because the things that you are absorbing will give you an extreme competitive advantage against other people that you're investing against, and then insurance and protecting the downside of your business. Because I think it's easy enough for us to make money. The biggest threat that we face are the roadblocks that we'll run into that could potentially strip that away. So if you're not a professional, stick to indexing. For our first time users, please keep it simple. And this is why. If you try and beat the market and fail, you're going to usually lose or do 2 to 6% worse every year after fees. So we talked about this before with negative compounding. And for those of you that are down 20, 25%, like imagine if you do this 3-4 years in a row, how you are going to feel. So this is my blueprint for beginners. So if I had to start Xander all over and had to talk to him, this is exactly what I would tell him. Step 1, invest in index funds first. Step 2, if you want to go outside of that, look at the top 3 companies in the world and pick the best out of those 3 and add that. 3, invest every month, unless you just have a big bag of money that you're hiding underneath your bed where you can throw in all in one time, but it's going to be a lot more comfortable emotionally to invest every month. 4, this is key. Please write this down. If you're looking at a particular sector, pick the top 2 players in the space. So on the retail side, Amazon, Target, pretty damn easy picks. Top 2 credit card companies, Visa, MasterCard. Everybody type in chat the top 2 video game platforms. You can make your own little mini index if you look at the top 2. And then number 5 is so important. You have to avoid all distractions, because not everyone that's giving you advice and saying, hey, you should invest in this, is looking out for your best interest. Some people are investing for purely excitement, not outcome. Not outcome. So this is your homework item of the week. I want you to hop on Google. There is an article on Medium. I want you to read all the Amazon shareholder letters from 1997 to 2020. It's only 72 pages. And write down the top 3 lessons that you've ascertained from the shareholder letters that Jeff has written over the years. And then you get to see the evolution of the business. This is a part of your fundamental research. Because when you start to read all of the letters that a CEO has written, you can see his thinking from the very beginning. And very key, we talked about fundamentals, I think, through 4 or 5 weeks ago. But how has the founder or founding team stayed on track with the initial vision? And then when things went bad, how did he adjust? So you get to see in real time decades of research and time invested into a business and how he's adjusted. And I think you'll be very fascinated to see some of his thoughts. So my question for you as I wrap up, are you going to invest for safety, or are you going to invest for freedom? For those of you, if this is your first ride down into election, you'll never forget these next 4 weeks, and it will make you a better long-term investor. And for my traders, even if you do bad and you draw down 20%, I'm telling you, the lessons that you gain from election night trading and up until election, you will never forget, and it will prepare you for the next crashes and strong pullbacks that we have. But I need to know, are you going to be an investor for the long term, for safety or for growth? Because I don't think any of you are here purely for excitement, because we're not here to gamble. So thank you. And I love you guys so much. Thank you. And I will not end the Zoom. I promise you.
Thank
Yo,
you.
talk about a masterclass.
Appreciate that, brother.
Ooh.
Appreciate that.
Yeah, man. And somebody missed the first assignment. The first assignment was to go figure out all 11 sectors and see how they performed over the past 20 years. I know somebody was like, what was the assignment? That was the first assignment. All 11 sectors, how they perform over the past 20 years. Find the top performers inside the sector.
That's a fact. So shout out to everybody on YouTube. If you can like this video, that would
Please like.
help the algorithm, and we would greatly appreciate it. So without further ado, we're going to bring on our guest, our pristine guest, Bonawyn Eison. Hope I said his last name correct.
I think you got it.
Can we bring him on?
Yeah, he's there. He's
on?
Yeah.
All right, Bonawyn, you just got to unmute yourself, and
camera's there.
There he goes.
What's going on, gentlemen?
What's going
on,
on,
brother? How you doing?
Doing great, man. Before I get into the meat, we start cooking up, I just want to say thank you, man. It's an honor and a privilege to be here. And what y'all brothers are doing for the community, like pushing the culture forward, educating people, like communicating at a level and making like investing fun and achievable and actionable and relatable. It's powerful, man. Like I am thrilled to be part. Consider me someone at your service. I'm down for the cause. All money in, as they say.
All money in.
I appreciate that, man. I really do.
Appreciate that, man. So it was a big day for you. It was on Fast Money, I believe, at 5 o'clock, right?
Yeah, I did the options action hit today. So just like the options part, I'll be back on full time Wednesday and Friday.
Yeah. So
can we talk about my baby real quick? What you said about Microsoft?
Well, first, I'm gonna introduce.
Go ahead.
So for anybody that, as I said, Bonawyn is a managing director of equity derivatives at XP Investments, which is options. I believe that's options trading, right?
Yeah.
Equity derivative. And he's also a contributor at CNBC. You probably, if you watch CNBC, I'm sure you have seen him. So yeah, we took one of their brightest talents and stacked them up real quick.
Yeah, you got to come over to the it's on the platform. Kind of spitting some game.
Yeah, so he's gonna drop a lot of gems, and we're gonna talk about stock market, we're gonna talk about options, we're gonna talk about investing, we're gonna talk about a variety of different things. So yeah, once again, thank you for joining us. I know this is gonna be fun. I'm looking forward to this. So Ian Winfrey, I'll let you kick it off. And
even Ian Smiley. Go ahead, my bro.
Ian has a long list of questions.
Yeah, I mean, I've been watching you. How long have you been on CNBC? 10 years?
Oh man, so wow.
I've been watching for a while. So I'm
so happy. I did an online segment for them, yeah, maybe about 8 to 10 years ago.
Yeah.
Fresh out the diapers too.
You killed your segment
like
too.
A bit more of an online segment. They were trying to, I mean, as you know, and you can see from all the retail companies and every other industry, like you need to have some type of digital brand, right? And I give CNBC, NBC Universal a lot of credit. We'll get into some of the other companies that I think have fallen behind there. But like the way that you communicate through media has got to evolve and change. And I think they were kind of, they were leaders in that, right? Like clearly they were looking to pivot or try new things, given what they have already in their television brand. And brand equity there. So I was doing an online segment talking about options and different companies. And then, it just got tough with work. I used to work with one of the guys that's one of the anchors there, Dan Nathan. And so he kind of got me involved. And then I did like a couple of sports shows or something, but like it was really, I was young in my career, didn't have the flexibility. And so, I just kind of had to make a decision between that and this. And fortunately, I will say the people at CNBC have been very good to me, continue to like groom me and bring me along. It can be a little nerve wracking, but I definitely feel like not only did they put me in the game, they put me in a position to win, which hopefully I can help our audience do here tonight.
That's amazing. And so my quick follow-up, with rates rising, and of course, everyone wants to know about the election. If Biden wins, what are some good sectors to invest in? And then if Trump wins, what's your take?
Okay, I'm going to deconstruct that or decouple those questions. I think the rate question, while correlated with the Democratic Party, I think is slightly different. So if Biden wins, I think he's been very, very transparent, which unfortunately we're not really used to getting that from politicians the last 4 years or so. But I think he's been pretty transparent in his intention as to move away from, fossil fuels into renewables. I think he's also been very, very transparent in terms of saying that he wants to invest into infrastructure. It's been one thing, and I'll get into this later, it's been one thing that to have this liquidity fueling this market. It's another thing to see real economic input, economic output. And you're seeing that breakdown right now in some of the consumer spending numbers and some of the industrial production numbers, right? Like you're seeing, you've heard the term a K-shaped recovery. You're seeing some people that are bouncing back, affluent people that have access to the market. Yeah, but that really only affects a small modicum of people in the United States versus the real economy. So sorry, to answer your question succinctly, Blue Sweep, I think you want to look at companies like alternative energy companies. TAN is a way to kind of play the ETF. For solar is a name that I pitched earlier. I look at companies like Roku and Cat, and that those are like, and you just mentioned, right? Like if you're going to go to a sector, the industrial sector, pick the winners, pick the leaders in those categories. And I think those companies speak to infrastructure building that will be going on. The Cats, the Rokus, the engineering companies of the world. In a Trump situation, I think energy does less poorly. That's been a beaten down sector. It's your traditional fossil fuel energy. So any type of sectors that are correlated to deregulation. So the banks, right? Right now, buybacks are restricted, dividends are being scrutinized. I think you'll see some easing up there. I think you'll see some easing or more accommodative type of policy towards energy. And I think that you might want to watch out for companies like Apple, because if we don't get this international relations and international policy right, I think the blowback of that is seemingly underestimated in a lot of these companies. And then on the flip side, Nike, if you just want to get into like the tax breakdown, if you assume corporate taxes are going to go up, you want to look for companies that have more of an international type of revenue distribution. So a company like McDonald's or Nike are very global in scope in terms of where their revenue streams are coming from.
So Bonawyn, in the event that Biden wins, and we're talking about international, especially with our foreign exchange and foreign policies, specifically a country like China, if Biden wins, is a good time to be looking at stocks and companies that are coming from China, specifically like maybe in the semiconductor field?
Yeah, I mean, that whole region actually, I think Vietnam is kind of an overlooked area as well. I mean, just to keep it simple, and I think a lot of times like we overcomplicate things, right? Pick up something that you see has been manufactured. I would say 10 years ago, everything was made in China. Half the stuff I pick up, I see made in Vietnam. I think VNM is the Vietnam ETF. You can kind of track the performance of that. I think it's rebounded nicely. What I think is that in the case of a blue sweep or just Biden, I think I mentioned blue sweep because it's harder to push through policy. You saw it with the Obama administration. Like you can have the best of intentions, but when you have these bipartisan wars, it's just hard to actually move things across the finish line. So in the event of a Biden win or a blue sweep, I do think you'll see a more diplomatic approach with China. I want to call things fairly both sides. I do think that the Trump administration has made some proper steps in terms of cracking down on the way China does business, right? Like they have a very protectionist economy while we're expected to be very expansionist and global. I think also in terms of some of the scandals that you've seen in terms of like gap accounting standards, they have not met those standards. So my point is I'm all about like a transparent market that allows you to really see what's going on. I think there can be a level of protectionism that's decreased. And I think Biden would probably be better at getting to that in a diplomatic way. You're not going to go in anyone's home and dictate the terms on which they're going to behave. Hopefully that answered the question.
Yeah, no, for sure. Let me jump in. Speaking about the energy sector, because this is a sector that we really haven't focused too much energy on. No pun intended. And I know that this is your specialty, one of your specialties. So you had mentioned the stock before, Buy First Solar stock.
For solar.
Can you talk about that? Buy First Solar.
So I mentioned TAN, which is an ETF way to play it if you don't want the stock specific risk. I think a lot of the gems you guys have been dropping on people are great, right? So like if you're not as comfortable with the space and you want to play an index or an ETF, It's a great way to get exposure to an overall theme rather than taking the idiosyncratic risk of that particular company. So with that in mind, in terms of why I want exposure to the sector, I mean, you're kind of already seeing the trend away from fossil fuels. I mean, the IEA came out, and I believe 25%, in 2018, I believe 25% of our electric output was from renewables. They're expecting that to increase by 50% by 2024. I mean, that's like ridiculous growth, right? And if you look at the performance of Tesla, NEO, or any of these other companies, like you're kind of seeing the hysteria around the space. Hell, you have GM coming out with what was it, like an electric Hummer?
Hummer, yeah.
Yeah, I saw that.
Tanks
Yeah.
next. I mean, it was, my point is like you're seeing, massive investment into that space. So that explains why I like the sector. First Solar in particular, I like the company just because I like the way that they go about funding businesses. Now, this company has been around, right? But if you look at their balance sheet, you look at a lot of other balance sheets of comps in that space, they use debt as a method to fuel operations, right? They have more positive free cash flow, but they have this debt balance, so much higher enterprise value vis-a-vis their market cap. But if you take a look at First Solar, they have like $500 million in debt versus about $1.5 to $2 billion of cash, right? So they could literally pay down that debt with cash if they so choose. They are burning cash, but as you've seen with a lot of other companies going through COVID, there are things you can do, whether it be layoffs or pressing vendors to kind of achieve operating leverage there. So for me, they're more in control of their own destiny, being that one, it's not really in this rate environment, but they can actually earn interest on their cash balance as opposed to accruing more interest like via debt. And I just think they're well positioned. So the pain points, and I mentioned this on CNBC, revenue growth and gross margins, I would like to see those things higher. But I think with that company specifically, being that they are like, they're positioned to be like a utility or output energy on a grand scale, the moves that the Democrats are saying they want to do directly speak to the pain points. I think they're just perfectly kind of situated for uplift if you were to get that situation.
So if we see an uptick in alternative energy, do you think this is like the beginning of the end for Exxon and traditional fossil fuel based companies that have had an 80 to 100-year run?
The beginning of the end as we know them. And you've seen that across a bunch of industries. I mean, there was an article out talking about a merger or acquisition of Chevron and Exxon. I mean, if that doesn't kind of tell you where we're at, I don't know what does. I mean, you talked about the VIX and how that points to trends. I think a lot of times we want to see what's going to happen, but like, again, like trust your gut. You see these massive secular shifts. I mean, that's like if you would ask someone 10 years ago, okay, Ford and GM, you think what's going on with these manufacturing behemoths, do you think they're going to change? Probably half the people would have said no, but they have.
They've adjusted,
they've changed, they've gone bankrupt, they've been bailed out, they've been restructured. I think you're going to have to see the same thing. I mean, whether it's the medical industry or the traditional energy industry, they have a large lobbyist group. So like you're always going to have to kind of fight through that. Yeah. But I don't think you can fight science. There's no way. You have companies, what is it? Blue Wave and SpaceX. You have all this exploration now on the next frontier because we are quite literally destroying our planet. So I don't think there's a way around it. I think you saw a bit of a head fake in 2005 when you had like the solar crisis. You saw a lot of subsidies in Germany, here, Australia. But I would liken that to the tech bubble in the 99, 2000, right? Sometimes you're a little bit too early for the secular trend. And I think sometimes the second time around gives you an opportunity to kind of learn from previous mistakes.
Yeah, we saw Tesla, obviously, with the solar paneling and obviously in the EV market. I want to talk about the other place of expertise for you, the financial sector. And I want to know your thoughts on how long you think it's going to take before they recover, because they've taken a hit, obviously, since Corona has taken over the world, really.
Yeah, I think you have seen some. So generally speaking about the financial industry, yeah, I mean, I think what you're seeing is, shout out to Karen Feinerman. She's kind of like mentioned this a few times on the show. I think that you're seeing these companies trade lockstep with yield curve flattening and steepening, for one. Secondly, I think in certain regimes, particularly when you have interest rates as low as they are, right, it's very difficult to earn free carry. I'll get into that a little bit later. That's in terms of, in addition to the stimulus that we're seeing, right? Like money managers have to put money to work. There's no way around that. I'm not paying you 2 and 20 for you to sit on cash. Yeah. You better find a way to generate some returns for me. Like it's that simple. Right? So,
bottom line.
Let me ask you this, and I appreciate, once again, this is a very high level education, everybody. So I hope you guys really appreciate this. YouTube 5,300. We're vastly approaching our record-breaking number. Alert. So please hit the like button. You're going to skyrocket on social media after this episode. By the way, but
I was trying to hide in the corner, man.
The hype is over.
And please don't DM my guy every day. Let him prepare and actually invest.
Yeah, he'll be don't worry.
So tech, we saw tech run up crazy since April, like all-time highs on the NASDAQ. So I said about a month ago, I thought that tech was overinflated. And then right after that, it started to go down. But it's still relatively high. Like if you look at the Dow Jones, we're not at the high, but NASDAQ, we're still like close to the high. Mm-hmm. So I understand that it's a stay-at-home economy, and the virus has helped tech companies. But do you think that tech is overrated? And what's your overall thoughts on tech as far as stocks are concerned, like in the broader industry, the NASDAQ, things of that nature?
Give your honest take.
I think the entire. Sorry.
No. I say go ahead. Give your honest take.
I think the entire market is overrated. It's not a tech specific thing. So yes, I mean, I guess the short answer is yes. I think it is overrated. In terms of you're paying such a high premium for what you're getting there. But you could have made this argument for the past 5 years in terms of PE ratios on the S&P. Like you would have missed tremendous growth.
Yep.
And that's why there's like the old adage of not being able to time the market. So yeah, but I mean, where else are you going to deploy capital, right? So you have sovereign interest rates that are at zero or below zero. You have monetary policy that's extremely accommodative. You have a fiscal policy that's pumping trillions upon trillions of dollars into an economy. You have a Federal Reserve that's literally buying the debt of these companies. And then you have a banking industry, kind of circling back to what you mentioned before, which are making the majority of their money right now on fee generation, whether that be, and a lot of that is capital market fee generation, right? So these companies know that they're going to be able to go back and either have their debt backstopped. So the yield that it's going to demand in the open market is going to be lower because you have infinite liquidity behind you. And then you're going to be able to go to the banks, which are getting squeezed on their net interest margin, which are going to trip all over themselves to issue your next issuance. So for me, it's kind of a self-fulfilling prophecy. With that said, I'd much rather pay these type of multiples for technology than I would for cyclical names, like without a doubt. Now, that's just me. I don't want to push my views on anyone else, but to me, it's not just about like the work from home thing. It's the fact that these companies like are still growing, generate massive amounts of free cash flow. I'm talking about $30-50 billion of annual free cash flow. And they have more, their cash balances are the sizes of other companies' market caps. Yeah. I mean, it's a phenomenal thing to see. And for me, technology fuels every aspect, whether it's new technological advancements in the healthcare industry, whether it's new technological advancements. I mentioned Roku, new technological advancements in terms of engineering and how you're actually like going through your data science and breaking down the efficiencies of how you're actually operating. I think it just permeates through all of those sectors. And in a lot of cases, Amazon, for example, whether it's cloud computing, in the retail space, transportation, logistics, you just see it like they're becoming vertically integrated behemoths. And it's like, to me, it's just hard to bet against that. But sorry, I a little long-winded there, but yes, I do think they're overinflated, but I just don't really know what a viable alternative is.
Can you tell the story of how you got into the business, and for anyone who's looking to follow in your footsteps?
Absolutely, guys. And if I'm going too long, please just like stop me short.
No, keep going.
I love this stuff, so like I'll just.
I don't think anyone's going anywhere.
Nah, it's all good. It's all good, man. It's all good.
How did I get started in the business? So I did this program my junior year of college called SEO, Sponsors for Educational Opportunity, and it was an internship program. I think it's SEO-USA.org is the website, I believe. And essentially what it did is it took, sophomores and juniors from undergrad and hooked them up with internships on Wall Street. And in addition to the internship, we had our own education process. Like it was like pretty grueling summer, but it definitely got my foot in the door because I knew nothing about investing. The whole reason I even wanted to get into the industry was like, I'm from Stockton, California, 209. I mean, I think it's Detroit and Stockton are the only places that were like bankrupt through the whole downturn, right? So I'm very appreciative for my upbringing, but like I just didn't get the knowledge at home, and I didn't even really know where to begin to get it. I went to college. There was a guy by the name of Deshaun Owens. He was into finance and economics, and I always noticed this dude had like nice stuff, but he was from a humble upbringing, but always was able to kind of make ends meet. And I just asked him, "Hey, big bro, can you kind of let me know what kind of things I should study or whatever?" So he kind of took me under his wing. He was telling me, "Listen, you should go this economic route." So I did that. Met a couple of other buddies that were telling me about these internship programs. Got to Wall Street, did the internship program. I'm a California kid that came out to New York and got my butt kicked, man. Like just not understanding just the aggression that one needs in the city and then one needs in that industry. It's like straight cutthroat, dog eat dog. I'll just give it to you straight. Just the amount of like work and time that one has to invest at a young age. I just wasn't necessarily prepared for that, but I met some mentors. A guy named Nadeem Sadiq gave me my first shot. Ruben Jacob kind of mentored me. Like guys, I just got fortunate, man. I did not dream. I was not the kid that was like in the investment club and doing all these things. I just kind of, I wanted the knowledge. I felt like that was my way out. And once, I mean, as you all know, once you like can taste it, once you let me get my hand on it, man, you're gonna have to kill me to get my hand off.
Take it away. Yep.
Yeah, dope. Yeah, shout out to Stockton, California. Our boy Hip 500 is from there.
Yeah, that's a fact.
That's a fact.
Just real quick, shout out to MG, shout out to Agate, and shout out to Quadir, my cousin.
In it?
Yeah, on the super chat. Appreciate all of that.
I got real quick because I obviously options is your thing, and our audience, and we're growing in that field as well. Two questions, two-part really. I want to know, how long have you been trading options, and when you do, is it typically a short term? And if so, I guess it's three-part. If so, what is the typical time frame? Are we talking for an option trade? Is it a month? Is it 2 months? Typically, what are you looking for?
Man, I started trading 2005, so 15 years.
Somebody say that.
And in terms of typical tenure of option, I mean, I don't want to like skirt around any questions. That's just like, there's no straight answer to that, right? It's like, what event am I trying to play for? What I do now is essentially I'm like more advisory and brokerage for institutional clients, right? But what I've done my whole career is take positions for the firm, provide liquidity, be a conduit of liquidity, make markets from the most simple call, put vanilla stuff to like more bespoke type of options. So it really depends on the strategy. Sorry, I want to give you a straight answer, but I don't want to like simplify it in a way that's like not helpful. what I will say is that I've heard and seen a lot of retail investors that liken cheap options to bargain options. And that is not the case. So just to like break down, again, let me know if I'm running a little.
No, go right here, please.
Keep going.
But to break down like the way you like how you're going to make money in options, right? So you're going to have your intrinsic value, which is what it actually is worth. So you have your strike in terms of a call. How much is that call strike in the money? So stock's at 30, your strike is 20, $10 of intrinsic value. Now at expiry, you're only going to pay that intrinsic value, right? Like, or fair value. But over longer term options, longer tenured options, you're going to have that intrinsic value, and you're also going to have that time value that you're paying for. Now, I can get into like the Greeks, delta and whatnot, but your delta is essentially going to be your probability of being in or out of the money and your rate of change. So if you have a delta of 50 or 30 or whatever it is, stock moves X, the options are going to move delta times X. Then you have your gamma, right, which is essentially your slope, which is the rate of that change. So think speed versus acceleration. Your delta is going to be your speed, distance over time. Your gamma is going to be the rate at which that speed changes. And with short-term options, that gamma is very high. Short time to maturity, your rate of change is very high. So you can go from in the money to out of the money to at the money very quickly. And you don't have a lot of time for that to reverberate and mean revert. Over longer periods of time, what you have is, even though you will have these massive oscillations, just statistically speaking, you have much longer observations. And so you have much more time for there to be mean reverting. Now, stocks aren't mean reverting, but the volatility of stocks are mean reverting. So any of you, like for you math buffs out there, like your squares, your integrals, those are going to be mean reverting. The linear path won't necessarily be mean reverting. A company can go bankrupt, company can get taken out. There's no room for that to go back. But if you look over the maturity of a company, what happens is, in its nascent, you'll see it. You'll see it in their earnings reports, right? Their revenues, their gross margins, all those things, as they're kind of finding their path, become more and more volatile. They're opaque. You don't really know. But as you get more and more visibility, have more and more observations, that's where your statistics really start to kick in. So to answer your question, these short-term options, if you really want to play for an event and you have a high amount of conviction in terms of whether this thing is going to finish higher, lower, or somewhere in between, that's your sweet spot. If you want a lot of time for that to play out, you should buy longer dated options. Now, something that I like doing is I like spreading my position, right? Because when you are just buying a call or buying a put or selling a call or selling a put, your risk isn't necessarily defined. Sure, you buy a call, your risk is defined, but if you insist on doing that, you need to have a stop. The same way you have a stop when it comes to stocks, right? How much premium am I willing to lose? You got to walk away when you get there. Yeah. Live to fight another day, right? It's all about maximizing the probability of success, because none of us are smart enough to make a right decision each and every time. Yeah. For the longer term options, what you can do is you buy that to kind of give yourself a base. And then against that, you can write options in the shorter periods of time to kind of fund that long-term purchase. Because, the last thing I'll say is the options I want you to like differentiate between ownership and control. And a lot of like my mentors have told me, listen, once you get to a level, you want to own nothing and you want to control everything, right? But like likening that to options, right? Options give you control of a position. They don't necessarily give you ownership. So you own calls, you have control of this company, but it pays a dividend. You don't own that, right? So what you want to do is pair off your right to control by writing other rights to control. And that allows you to kind of like pick up and fund your trade over longer periods of time. The short stuff, there's just not enough time for it to snap back. So I think there's a right a balance. You should have both in your portfolio, or you can. I shouldn't say you should. You can have both in your portfolio, but just the way, like, you really need to understand what it is that you're playing for, because you know the long-term stuff you can be right, but it can move back against you.
Yeah. So I just wanted to ask a question real quick, Ian. So you're saying, just for clarity, like if you have a long-term option call on like an app or whatever, play short-term calls during that duration at the same time as you have the long-term call?
Sorry. I was like reading the comments and I saw someone say, own everything, control everything, own nothing. I'm like, that's not my advice on life.
You're not endorsing that. You're not endorsing that.
I was like, wait. That's not.
Comments will get you. The comments, clear that up. You know, I saw them put your whole bio up in the comments. I'm like, oh no, he can't hide no more.
No, he's not endorsing that. No, what I was saying is that
Sorry,
you buy a long-term option, but you're trading short-term options of that. So it's like Apple. You have an Apple 2023 call, and you have like the June of 2021 call and March of 20. Is that what you're saying?
Exactly, right. So that one, like, or a calendar spread is what we'll call it. So when you own the longer dated option, you own control over a longer period of time, right? It's like basic negotiation, right? The person who has the longest time to wait, probably in the better negotiating position. So you've done a good job. I know we talked about this briefly, like you have an affinity towards more longer dated options. That gives you control. But against that, you can be selling people options that may or may not expire in the money. And if they do, you just exercise your control, or what I would suggest, rather than burning all that money, sell out of that to close that position, rinse, repeat.
I have a two-part follow-up. So we talked about risk. So as a futures trader, hedging risk is the most important thing. What's your favorite risk to reward ratio? And then your trading size, how do you overcome a loss and deal with that emotionally when you have a trade that does not work out?
Okay, yeah, I got a story for you on that one. Ideal risk reward. Again, it's going to depend on the tenure, but I'll, as I said, I like spread trading, whether it be vertical or horizontal. Vertical is between strikes. Horizontal is going to be through expiry. If I can put something on where, so think about the spread between the distance of the spread, right? If I can put something on where I'm paying 1 to get something 3 to 5 back, I like that risk reward.
Okay.
Conversely, if I'm writing options and I'm writing an option and I can collect 40% of that spread to give them, and in the event that I lose, I pay 60. I like that. I like those type of situations.
Okay.
Did I answer that?
No. Great answer. Great answer. And on the ones when we, I know we don't want to talk about losses, but they happen to everyone. How do you emotionally recover when you have a big loss, since you are trading size?
Tequila and Hennessy.
Let's keep it real. Let's keep it real. I love that.
Yeah,
I love that.
Eddie Nation, what up, Mike? What up, man?
That's funny. As a quick follow-up, what was one of the biggest losses that you may have experienced?
Let's see. So, man, this is when I first started. I was trading. I'm going to leave the tickers out. It's in the past, but just so I'm safe. I was trading a home builder portfolio through that crisis, leading up into that crisis. And there were instruments there. These are OTC instruments called variance swaps. So you talk about calls or puts, those have like linear payout ratio. And so we talked about gamma a little bit. And I don't want to, like, I hate when people get down and like bog down in technical speak and try to sound intelligent. So if I'm doing that, feel free. I want this to be like a family type of discussion. But you have these variance swaps, and the whole point of them is to essentially replicate a constant gamma profile. So if you buy an Apple 230 strike call, and the stock is at 230, maximum gamma, but as the stock runs away from 230, you don't have as much option exposure.
Okay.
There, right? This is like something that was created to kind of replicate a constant gamma portfolio. So you got to hedge a bunch of different options against this one structure. So, man, I had this position, and I had been like buying some gamma in some of the single names versus these variance swaps that I was getting, that were getting purchased from me. And I marked the variance swap, and I was still kind of learning some of the tools. I was young. I marked the variance swap, and man, and this thing was down a few million. I got up from my seat, excused myself, just went to the bathroom, puked, straight on the spot. fortunately, I had like hedged some other stuff, so I marked those positions and I had made a lot of it back. But that was kind of like the first gut punch where I was like, man, I can't even count. I've never seen that much money in my life. I can't even count that high. I'm pretending. You doubt yourself.
Yeah.
You start to doubt yourself. You're like, yo, man, I'm about to get exposed. But what that taught me was, and I've traded a lot of high volatility books. Like if I have done my due diligence, and my conviction, like me, like kicking over every stone and being a jerk and demanding answers, that happens before I get myself into a deal.
Yep.
So once that deal is there and it goes against me, if my fundamental thesis hasn't changed, I'm not panicking. Or if something hasn't changed that makes me acknowledge that, hey, you just got this wrong, no. Like I can stick it out. Now, keep in mind, I'm going to have some stop losses in there. There's a level at which, where no matter how much you think you're right, you have to get out of the position because you got to live the fight another day. But the due diligence process that goes into putting on a position is critical, at least for me. That, along with the quantitative metrics that I use, that gives me something to lean on when ish hits the fan, as they say.
Yeah.
And then not following the crowd. When and we're all guilty of it, like when you momentum trade and you think you can just ride the wave, human psychology flips on a switch.
So fast, yep.
And so, I mean, to answer your question, man, like it's really the due diligence and the research and the questions and like the rigorous lead up to that, which gives me the ability to kind of ride that out. I mean, I know I'm not going to be right all the time. It's about being right 51% of the time. And when I'm wrong, mitigating those losses so that those losses are much lower than my wins.
And then what percentage are you putting your stops at?
Again, it depends on the situation. But I mean, okay, I'm glad you asked it. Great question. So I'm going to go back to your metric, the VIX. The VIX will give you a barometer that you should be using to determine how much volatility is going to be in that market. I think people kind of like, there's a misnomer of it being a fear gauge. It's not really a fear gauge, the volatility gauge, right? If you take the square root of, so you have 252 trading days in a year, right? Take the square root of that because, again, we're talking about option volatility here. So volatility is a square root of variance. So you have to deal in squares. Squares are additive, but your square roots aren't additive. So if you have like a squared plus b squared, you can't, that's not ab squared, right? Square root ab, I mean. So you take your square root of 252, that will give you 15.84, call it 16. Divide that VIX number by that, that's the percentage move that the market is pricing in to the general market.
Okay.
That's there you go. Crack the VIX code for you.
For those of you not listening, please write that down.
Don't let that go over your head.
Please write that down.
Yeah,
one more time, please.
Run that back.
All right. So your VIX is telling you what the implied move of the S&P over, I believe, a 3-month period is. It's a blended move, right? But this is for any option. If you look at the implied volatility, you take the square root of 252, which is the number of trading days in a year, because everything is normalized for the square root of time. And the reason why I'm telling you that is because, again, variance is a square, volatility is a square root. So you've got to normalize things so you can compare apples to apples. If you take square root of 252, if you put that in your calculator right now, you're going to get like 15.8485, something like that. Call it 16. If you take the implied volatility or implied move, so the VIX, which is a volatility index, call it, it's about 35 right now. If you take that and divide that by roughly 16, that output will give you the move, the implied move of the S&P in percentage terms. So when you see a day like today, the market's moved just under 2%, and you see the VIX at 34, like, hey, and they just
that's
told
in the
you.
normal range. That's a great equation.
The problem is when you said take the square root, and you lost 98% of the people,
I'm gonna do that in my iPhone.
including myself.
But this is a part of teaching to fish, though.
I guess
Yeah.
math class wasn't as overrated as I thought it was.
We'll talk about education tomorrow.
Yeah,
But I'll tell you, it's 16. It's roughly 16.
I apologize.
That's a lot.
Yeah, I gave people bad information about not having to go to math class.
That's the trigonometry you skip.
Geometry, trigonometry, algebra, advanced algebra, calculus,
Yeah, you got all.
you name it. Shout out to everybody on YouTube. We have
Breaking news alert.
We had a tie. We had a tie right now for our all-time high, 5,400 people. You're right up there with Budgetnista. You know her? Budgetnista, you ever heard of her before?
Sorry, you talking to me?
Yeah,
What name again?
Budgetnista. You're in good company. Don't worry.
Thank you guys so much.
Are you a noob?
I am.
Yeah.
What college did you go to?
Stanford University, Lamb the Noob, Living Nightmare Chapter, Spring 04, Deuce Club.
Okay. Shout out to all of the fraternities out there.
I'll tell you about the IU I went to school with. Noob.
He was like, we ain't ask you to step, brother. Just go ahead, man.
That's funny.
Oh man, now this is very enjoyable. We're gonna try to get some questions in.
You want me to just run off the earnings real quick?
Yeah,
we're gonna do
real quick.
So about this is what we usually do at the 9 o'clock hour, but since there was a masterclass going on, we said we're just gonna let it run. So I'm just gonna give the earnings of some big earnings that are coming this week. Obviously, we spoke about before that the FANG stocks will be reporting. So let's obviously Chegg and Twilio reported today, and if you've been following Chegg, this is a stock that we spoke about early on, what was that, like May we spoke about Chegg?
Yeah, May, I think, May? April and May, yeah.
Chegg and Twilio reported today. Tomorrow morning, Cap will be reporting, and tomorrow afternoon, another two stocks that we've been talking about heavy, AMD will be reporting as well as Microsoft. And then Wednesday, Shadi's favorite stuff, Boeing will be reporting as well as Sony. And then Wednesday afternoon, man, it's a big one. We got Etsy, Fastly, Gilead. Jamal, hear this? Teladoc will be reporting. Visa and ServiceNow, all stocks that we've spoken about before. And then Thursday is the big one. AM before the opening, we got Shopify and Mondera. And in the evening, right after closing, we got Apple, Amazon, Facebook, and Google. I mean, it don't get bigger than that. And then Friday, we got Honeywell, which was added to the Dow Jones in August, and Charter Communications as well. So those are our earnings for this week. It's a big week.
I got a quick follow-up before we go, so I'll get my Tavis smiling real quick. As a pro, what indicators are you using to assess where you want to get into the market, or what quantitative tools, if you're not able to share, what indicators you like?
Oh no, that's fine. Definitely price to earnings. Definitely 200-day moving average, 50-day moving average, previous lows and highs, volume. I mean, all of your technical indicators. I think when you see like a stock gap and then fill in that gap, I see a stock start to base for a while. I see that as an upside indicator. Previous support and resistance levels are like very key technical indicators, particularly when they're coupled with legitimate volume. And then, as I mentioned, I look at percentage moves versus the implied volatility of a stock. And that will give me an idea of whether or not it's within a normal kind of like distribution, right? When I start to see 2-3 sigma moves, you gotta kind of change your calculus, right? You shouldn't be riding those type of waves.
Bonawyn, can you just turn your volume up just a little bit? I feel like you got a little bit lower on us.
Is that all right?
Yeah.
Should be
all right. Yeah.
Let me know if it's
Yeah, I think it's back to where it was before.
Yeah.
What about
I apologize to all the math geniuses out there. It was a joke. It was a joke, people. It was a joke. I'm not looking down on anybody's mathematical brilliance, man. Don't take it too serious, ladies and gentlemen.
And over what time? Troy, go ahead.
Yeah, because I'm gonna ask you too, because I mean, you told us, and both of you could kind of answer. You said 47 was the number when we're looking at the VIX. But what would tell us that we're okay, right? Does the VIX need to be in the teens or the early 20s? What number would indicate that, you know what, we're okay?
like to try to give you a straight answer. I mean, man, in recent regimes, you see the big sub 14, sub 12.
Yeah, right.
Like less than 1%. That's like normal. I mean, we're still rich. It's just that like I think this is the new normal. Like I think, and if I can kind of go off on a tangent, I think people have to understand that this is not a normal trading or investing environment. And what I'm seeing in a lot of questions that I get is that people are like chasing the next hot thing. If sell-offs like that happened in March should not happen routinely. That's gone. You got to move on to like the next.
It's a different area.
Right? Like, so it's like, okay, what's the next Zoom? Okay, what's the next this? It's like, oh, people
Once
are
in a lifetime.
Yeah, man, people are chasing these moves as if they're a new normal, and I really want to caution against that. This is not a get rich quick type of game. This is a stay in your seat, keep your shirt, maximize your odds of winning game. Like anything else, right? You're not going to just hop in here. All types of market. I mean, I'm just a guy, right? You got all types of like super quantitative bots that you're trading against that are like scraping Twitter for news and like, you know, moving things around in micro milliseconds. Like you're not gonna compete in terms of that, trying to get rich quick. You have to find your lane, your area of expertise, and exploit that. But trying to just ride the next hot thing, I mean, best of luck. Maybe you can get up here and tell me about it, but
I appreciate it.
Shout out to Wall Street Trapper. We were speaking yesterday, and he was like, yo, that was a once in a lifetime opportunity. He said something to the effect like that was historic. Like what happened from March to September, that wasn't normal. So that was legendary. Yeah. So
I mean, I literally waited from 2009 for that move. And to be very honest, no one fully took advantage because when we dipped that hard, it's still fearful. You didn't know if the Fed was going to stop printing. I don't have inside information. So the reason why I give so much reverence to you, because not many times do we get a chance to talk to someone who's on the pro side. So these rules are so key. And once again, thank you for sharing some of your insight. If I could ask you, what's the best piece of advice you've ever received about investing from anyone you've met or maybe a mentor?
First of all, thank you. But man, I respect what you do. I've got a chance to look into your stuff. Like I said, man, I'm honored to be here with you guys. So I'm just one of the fellas.
I appreciate you, man.
100%. I mean that genuinely. In terms of best advice, man, there's a lot, and I don't want to cut anybody out. Few quick anecdotes. Bulls get rich, bears get rich, pigs get slaughtered. Don't catch falling knives. Don't step in front of freight trains. Man, I feel like I've been told that so many times.
Yeah, it's a great lesson, though.
I think everyone's heard cut your losses, ride your winners, but I think it's harder to do psychologically, which is why you put in stop losses. Like, take away all of the emotional response. Like, we are emotional creatures. We're wired that way for our survival. Trading should not be emotional. You need to make that as clinical as possible. You get to a level, that's where it is, that's it. That is it. Another thing that I like is, like, if I have a stock, right, and we've seen a lot of stocks double, triple. See, you're in a stock and it's doubled or tripled. Take that same inverse ratio, sell that amount, and you're in for free. So I've heard, like, and I think you guys are right, but I've heard people say, okay, if you owned Apple, you never should have sold it. Now, I'm with you. Don't sell good companies. But risk management is also key. So if you're up double, if you sell half or a quarter, if you sell half, you're in the trade for free.
That's
and
true.
If you have owned half of your Apple position from 2005 till now,
Oh my God,
you're still printing, you're still minted,
yeah,
and you sleep well at night. What else, man? I will say there's the advice that I've gotten from investing versus trading is different. Trading is much more about being calculated, understanding trends, putting in stops, being super diligent. It's just an unemotional, boring game of just making sure that you do the same mundane task over and over again and just being very rigorous. On the investing side, and you guys have really hit the nail on the head again, kudos to you all. I think it's more about like understanding that you should be in low fee indexes or indices, because at the end of the day, like the basic core tenets of finance are time value of money, or time accretion, and compound interest. Like that's your basics in terms
Holy
of
grail.
finance, right?
Yeah.
So give yourself time. You're not going to do this overnight. Keep fees to a minimum. Establish a core position. And then like when you want to do some short-term option trades, or you want to hop into the next hot stock or whatever, you can like allocate small portions of capital to do that. I think you should, I mean, man, I'm going to get crucified for saying this, but I think you should have some stock trick-off money, right? Like better than going to the club and blowing bottles or doing something else stupid or buying a Chanel bag. Like
That's true.
Go take a chance. Because
more bottles. We just broke a record.
Breaking news alert.
5,500.
That's a big fact.
Yeah.
Yo, now
Amazing, man.
Part of history.
Bonawyn, you have etched in EYL history now.
Yeah.
I appreciate it, man.
If you want to see Bonawyn back sometime in the future, drop a one in the comment section. Let me.
Legendary.
Oh
let's,
boy.
let's see.
Oh man. Oh.
Yeah, you're gonna break the internet.
Yeah,
you're gonna come back.
Actions, EYL.
You gotta put in your bio. EYL. Market Mondays contributor. CNBC / Market Mondays contributor.
I like that.
Contributor.
Yo, any book recommendations? I know Ian loves Money Master the Game, and that's obviously what our books are reading right now. You have any, or you gonna go with that one?
Yo, Money Master the Game is.
Come on.
Yo, and I'm telling you, I read that
man.
as someone who's like experienced. Yo, that book is fire. Breaks it down in like such detail. If you want to get more into like options trading and some of like the more technical aspects of it, there's a book called Options, Volatility, and Pricing by Nattenberg. This was the first book I was given to read. Options, Pricing, and Volatility, last name Nattenberg. And that will go through, like, that will break it down for you. And for you math buffs out there, there's a book by Hull, Hull.
Oh, yeah.
That will get into more of, like, the nuances around the math. I don't know if you necessarily need it, but, like, you know what? I don't want to put limits on you guys. Like, go out there and be beasts. Like, there's nothing that you can't, like, understand or do. You might as well. I mean, do it big.
Paul has some amazing indicators too. A sector that I've hated for a while is banking, but are there any banks, if you can't touch on it, you don't have to, that have good trading operations that you think could last through COVID and election?
Yeah, I do actually. So like, I like the money center banks that have trading operations. I mean, again, man, you're sharp dude, man, all over it, man. Yeah, this dude is blessing y'all.
I appreciate you.
That's Ghost right there.
Yeah. My brother just texted me. He said, "Yo, y'all got Montana and Brady on at the same time. This is great."
So banks, right? I like the money center banks that actually still have trading operations, because if you looked at the previous earnings, right, you've had all these write-downs for possible consumer debt, right? So if you think about banks, like they're in the core business, borrowing short, lending long. That's just what they do. You talk about the overnight rate or the repo rate. They borrow money. They have like a 1 to 9 or 1 to 10 ratio where they have to have hold against your deposits, and they literally go out and lend money. It is like the oldest trick in the book, right? And then on top of that, you know, they have credit cards and fees and everything else, right? But what you've seen is when the consumer is damaged, and again, I'm going to go off tangentially, like this economy, this American economy, make no mistakes about it, is fueled by consumer spending.
Mm-hmm.
Point blank, period. And I'll take that a step further and say it's fueled by debt-induced consumer spending, like the worst kind.
Yeah. That's
how these companies are getting rich, off of people, to y'all credit, buying liabilities instead of assets. So like, that should stop here. So once you understand the way these banks are making money off you, I'll say like you're seeing now a trend towards more of the retail banking. You just have Morgan Stanley. I think they just bought Eaton Vance. I forget what company that they just bought. But essentially giving them exposure to more retail, more fee generation. Essentially, I listened to your show last week where you likened it to a toll booth. I don't care if you go, leave, stay.
Yep.
I mean, I'm clipping my coupon. But sorry, to answer your question succinctly, JP Morgan, Goldman Sachs, Goldman Sachs, and Morgan Stanley are the kind of companies that are on my radar. I think JP Morgan is top in class. Goldman Sachs, specifically to your question, is renowned for their trading acumen.
Yeah.
Morgan Stanley is just a well of a equity house, and I think they have kind of diversified into lower volatility, more visible revenue streams. And then I wrote these down. I think, but I can tell you off the top of my head. I think what you're seeing now is a lot of these banks are trading at like 1 times price to book, right? Which means like the assets that they have on their balance sheet, the level at which they carry them, the stock is trading 1 for 1 with that. I think JP Morgan trades like 1.2 times. I think Goldman Sachs might trade like 0.9 or 1 times. I think Morgan Stanley is trading down to like 85% of book. Now, keep in mind that they have already went and written down billions of dollars. So you're getting companies that are trading at low ratios to book after said book has been written down. So I feel you in terms of not necessarily liking them. They're like utility stocks. The dividends might come under scrutiny, but like I think you buy good companies at cheap levels, and I think some of those fit the bill.
What's the industry consensus of why BlackRock has outperformed Goldman at such a wide scale in terms of stock price, even though Goldman has a strong arm? BlackRock.
Offerings. I mean, think about how many ETFs they offer. Creation, redemption, business, like they're just, it's fee generation.
Okay.
I mean, sorry, like I can give you a longer-winded answer, but I'm trying to like kind of cut down on my verboseness.
Yeah, and I want Rashad and Troy to jump in because we'll be here for 5 hours.
I was going to say there's some people here who are here with us, like 700 of them. I was going to maybe take one.
That's right.
They said he ain't got no guidelines tonight, so
go ahead. I'm trying to extract all the gems I can.
Hey, yo, I really wanted you to ask the Verizon one, man. Can you do that one? I really like that one. That was a good one. We'll save it.
Yeah, we'll save it.
We'll save it.
Yeah, let's try to get two questions in. Sorry,
I'm going to a new name.
This is obviously a very special episode, and we had a lot of questions, and it was a lot of information to cover. So we're just trying to get 2 questions in. So make these questions. You're under a lot of pressure, actually.
Oh man, it's a newcomer. You gonna do that?
Yes, I am going to do that. Congratulations.
Is it Marsley?
Friends like y'all.
Marsley, you've been unmuted. Unmute yourself. I hope I said it right.
Yeah, it's Martelli.
Martelli, what's going on?
How you?
No pressure, bro. What's going on?
Listen, appreciate y'all, fellas. Appreciate all y'all do. Gentlemen, a question I have for you is, Ian at one point mentioned how the election and the certain pricing, certain numbers that I think the Dow has to get to, so we'll know who will win the presidency.
S&P,
Yeah, the way you're looking at it right now, brother, do you see, are we going to reach those numbers or what?
But I will say this though. I think with North Carolina being up for grabs, and 2016 is different than 2020, and I'll let the brother chime in. The landslide or the secret victory that Trump had in 2016 is different in 2020. With cases spiking and the economy not doing as well, it puts the election up for grab. So I think if we continue to slide for the next 2 weeks, definitely if we crack anywhere underneath 3,000 and cases go up, it may be a home run for Biden. But I'll let the brother speak and let him tell his perspective on if we'll drop in these next 2 weeks before election.
I'm gonna skirt dodge the
as you should.
I'm sorry, I'm gonna have to punt that one.
Appreciate it.
Well played.
Yeah, I
But
mean, we only got, go ahead.
no, in terms of my view of the market over the next couple of weeks, sorry, these comments are hilarious. Keep your job, player. Thank you.
Yep.
Yes, I got to skirt the political talk. I'm not going to like condemn anybody, but I will say is I think the risks right now aren't necessarily a Trump or a Biden win. It's like a contested win or a disputed win, or as we've been on record saying, not essentially, I'm not going to leave peacefully. Like that is
Yeah.
unprecedented. Like, and I think what people that fear is still very much in the market. And I'll say the second thing is kind of like fiscal stimulus, the size and scope and where it's going to be targeted. Is it going to be $2.5 trillion? Is it going to be 800 billion? Is it going to be 1 trillion? Are we going to bail out quote unquote blue states or states and local governments, municipalities that are kind of under pressure? I think so. Yeah, I mean, I don't see much upside for the next 2 weeks. Like, why? What? Like, just from a risk reward standpoint, why would you put money to work right now? Because we're back near all-time highs.
Mm-hmm.
Maybe you make another 3%. Maybe you make 5%. But you might drop. I don't want to put fear into people. But my point is, the risk reward is now asymmetric. I don't have a crystal ball. I can't tell you whether it's up or down. But if I'm purely, again, taking out the emotion, and I'm looking at expected value, right? And I say, okay, it might be up, it might be down. If up, then up by how much? If down, then down by how much? Now attach a probability to both of those situations. I'll tell you, for me, the expected value is less than 0, which means you don't. Clinical. That's just like no emotion.
Yeah.
Yeah, that was a good question. I
Well,
appreciate
Charlie,
that.
appreciate
I
you.
was actually planning on asking Ian that question as well, like based off of that, where is it going? And it was looking like it was going up, which would have favored Trump, and then it started to come down, and then it's been like on a spiral. So based off of the numbers that we did previously, Ian did it. I don't know.
Yeah, I mean, from a technical standpoint, for us to bleed back down to the 78.6 based off the 5-year, earnings will have to be terrible all week, and then cases will basically have to double every 3 days for us to dive down that far. Anything is possible, but the probability of it is lower.
All right, we're going. Avina, I hope I said that correctly. Avina, unmute yourself. You've been unmuted. Go ahead.
I don't know.
Yeah, I mean, from a technical standpoint, for us to bleed back down to the 70.
You got
You got your.
you got YouTube on too?
Yeah. Mute out, please. Basically, have to double.
Yeah, mute him.
Wasn't
ready.
He wasn't ready. Fridge breaks. He watching us on play.
Probability of it is lower.
Nah, bro. No, nope. We're not gonna do that. We're not gonna do that. Sorry, bro. Sorry.
I'm sorry I took up all the time. I was trying to get the most out
Nah,
of
we're
it.
gonna go to Stanley. Stanley, we coming to you. Unmute yourself. You've been unmuted. Stanley, like, oh no, they called me.
Nope.
Come on, y'all. Squeeze these
5,
questions
4,
in.
3, 2,
Nah,
1.
he going. Ian, you want to ask the telecommunications?
Go to Mark.
Yeah. Yeah, I'll squeeze it in. So on a macro scale, what's the insight that, well, how long will it take for the economy to recover? Not the market, but the actual economy. And then, like, I've hated AT&T for a long time because of, I think the business model is inferior. Does the industry think that like legacy companies like AT&T, GE, IBM, we're seeing the beginning of the end? Or once again, do you think they'll start to rebrand and become powerhouses again?
I'm gonna take the second question first because I think it's just like a more straightforward answer.
Mm-hmm.
I think I'm on record giving my views on AT&T. It hasn't participated in what has been an era of tremendous growth and upside. You've seen, and again, man, I realize running companies are difficult, so I'm not here to smash anybody, but
yeah,
you've seen mergers and acquisitions that have failed. I think when you see yourself paying X, selling companies for half X or pennies on the dollar, and then if you look at like the ballooning debt balance at AT&T, now I get it. I understand why they're selling Dish. They need to shore up finances. They need to get some cash on the balance sheet. But I think they're just behind the 8 ball, right? Like now, to their credit, I will say I think like 90% of their revenue comes from services as opposed to like actual hard. It's, these comments are wild. Um, so like at least that's like service business, but the issue is that there's still a capital intensive business. You've got these satellites, you've got these in-home infrastructures, they do fiber optics, all those things are like capital intensive like businesses. You need actual hardware. So now you're looking at, okay, now I have to like have some type of return on equity or return on capital, just a much more difficult business to kind of push through, as opposed to a data center or a Netflix, where really they're like, okay, what we need to do is we just need to go and get content. I mean, content, fine. What, you need a hard drive to store content, and you need some distribution channels. And so I just think they've kind of chased, and as opposed to growing some of these things organically, they've chased these acquisitions and have paid premiums for them repeatedly, and they haven't worked, which clearly I think cripples your ability to kind of move forward. On the IBM side, I think you have seen them kind of pivot a little bit from personal computers to more of like a consulting type of service. I think there is something there, but like clearly that wave has faded.
Big man.
Pardon? And then you asked me about GE. Stock price tells you all you need to know there. It's like, are they a financing company? I mean, so they've gone from a hardware company
I don't know.
financing the being more of a financing company, and now they're kind of trying to pivot. I think these companies can survive, or they'll just get bought. I think IBM has done a decent job. AT&T, I give them credit for like attacking a weakness, but I feel like they laid down short. As far as, sorry, what was the first question you asked me in terms of how long it will take for the economy to bounce back?
Yes.
I'm glad you decoupled the economy from the market. I think a lot of people get those two confused, and I think that our current administration is heralding our economy and heralding the market and likening that to our economy. Yeah. So if you look at the economic indicators, right? Like, so you have still record unemployment. You have industrial production, which still shows that there's slack in the economy. I realize that we got to jump in terms of consumer spending numbers, but again, a lot of that was spent on goods as opposed to services. So like those are not going to be recurring revenue stream. You have a consumer that's had a highest savings rate that it's had in modern history. And you have the end of benefits. And you have what, in my opinion, fiscal policy that is geared much more towards large mega cap bulge bracket firms. Buying their debt, issuing liquidity, access to capital markets, all of those things only really apply to publicly traded companies. But 40% of the U.S. economy, 40% of the workforce are small and medium-sized businesses. As you've seen how the CARES Act and PPP, trying to get those loans, having the administrative wherewithal and paperwork to actually go and be able to get approved. I think that aspect of the economy is still very much damaged, and I don't see that coming back anytime soon. What I will say, and what I think is great about this country, is the innovation. I think what you're going to see is some of these companies are gone; they're done. Right? When we talk about vertically integrated businesses and some of the big tech names, but small mom and pop shops, sometimes they only have one trick. It's not like they can squeeze vendors. It's not like they can increase costs to customers. You're going to go to somewhere else. And they also have to compete with the likes of other well-capitalized competitors. It's like they don't have the ability to pivot or move to a different revenue stream. So I think those businesses are going to kind of be impacted and to an extent won't come back. You've still seen it in the travel and leisure sector. You've seen it in hospitality, restaurants, and we're going into winter. I don't know, how we're going to get through that. You can only socially distance and be sitting outside for so long. I mean, I'm on the East Coast. Come December, man, that's going to feel like up north in Game of Thrones. You're not going out there.
There's no sitting outside to eat there.
So, yeah, man, I think, like I said, you've heard the term K-shaped recovery. I think you've seen it for people that have disposable income to invest in the market, people that can afford to buy a home, people that have credit or haven't had their credit impacted because of not having a job so that they can go get a loan. So you have rates at all-time lows, but if you look at the banking standards, the hurdles to actually get those rates, those are at cyclical highs.
Yeah.
So you're just not seeing the liquidity actually be dispersed to the part of the economy that, in my opinion, needs it the most. I think what you're going to see is a rebirth of sorts, but I think this rebound is going to be protracted, personally.
Yo,
I appreciate that, man.
Can we go? I got my man Marcus. Thank you for being so patient, man.
Shout out to YouTube. I'm reading all those comments too, man. YouTube
You guys are funny. YouTube is hilarious.
The earners is on fire too, man. Shout out to them.
Shout out to you,
Marcus. What's going on, bro? You been unmuted.
Chilling. How y'all doing today?
You doing
Good. How you doing, brother?
Good. That book club was fire. There, it was good. And Ian, Red Panda, loving it. Brother,
you, brother.
Is it Bonawyn? Look, English is my second language. Did I say it right? Bonawyn?
Bonawyn.
Yo, a lot of gems, man. Really appreciate it. I actually got a question for you because on the beginning you started talking about China and the relationship that Biden would have if he gets elected. Once he's in, that it will probably, be a lot better than it currently is with Trump. Meaning that there's also a lot of companies right now that have been on the stock market, like Luckin or whatnot. Is it smart to even think about investing in any sort of Chinese ran company? Because in the end of the day, if you really think about it, it's not really owned by the CEOs, it's owned by the government. So is it smart to invest in any companies at all, like the NEOs and whatever ETFs that's predominantly ran or owned by Chinese? Is it smart, or should we just stay away from them?
Great question, Marcus. I appreciate it, my man. Yeah, I mean, listen, state-run enterprises are nothing new, and they're not only specific to China. You see the same thing in a lot of emerging market countries. Petrobras is state-run. Vale, there's a state-run aspect to that. Electrobras, so it happens. It's not just China. Yeah, man. Companies like Alibaba, I wouldn't care who owned it. That thing prints money. Now, you look at the size of the Chinese population, and I'm not here to debate international diplomacy. That's way over my head. Studied IR in school, but I forgot everything I studied. I just held on to the path. But listen, money is green everywhere you go. Companies are in the business of making money. State-run companies, just like private enterprises, are in the business of making money. And that Chinese economy has bounced back and has been exemplary. And I'm not rooting for or against anything, but purely by the math, China has bounced back from this economic downturn in ways that is exemplary, and we should probably be taking some tips on how they did it. Now, I'm not saying to force people in their homes or whatever. I'm talking purely economic data, output, production, GDP. They have bounced back. You've seen the economy growing. They do everything from manufacturing. They're protective of their companies. There's censorship and all those other things. But keep in mind, people are gonna never doubt the propensity of the global consumer to spend. People want to spend their money on something, whether you're Chinese, Brazilian, American, Mexican, or everything in the middle. I think that shunning an entire population because of some diplomatic issue, I think that's old school. Not targeted at you, but I think it's ignorant. We've seen it in the past. World War II, people didn't want to buy cars from Japan or whatever. The world is way too global for that type of protectionist type of mentality. So yes, good companies, no matter where they are, I think you can buy them.
Yeah, they got something very interesting. I'm not sure if anybody's paying attention, but they have one of the largest IPOs in history, the largest. The Ant Group, the IPO is going to, I think, 34 billion IPO. Ridiculous. So that should be.
The Ant IPO, yeah, man, crazy. Yeah. Saudi Aramco, also another massive IPO.
Yeah. I mean, just different level.
Bonawyn, appreciate you, brother. It was a pleasure.
Superstar, I appreciate you, man.
Yeah,
I appreciate y'all, man. Like I said, it's a pleasure.
We spoke several times, and I'm glad we was able to make this happen. Like I say, anytime you want to come back, you always got a home here, and look forward to just fostering a relationship with you. So, how can the people follow you on social media? What would you like to tell the people? How can they watch you on CNBC? Like, what are all the information you would like to give out?
I appreciate it. First and foremost, if you have me back, I'd be thrilled to come back.
Come on, man.
As I told you, I can't tell you enough how much I respect what y'all do. It's awesome. It's awesome. And so to even be tangentially associated with it, bruh, like, I'm proud of you guys. Like real talk.
Appreciate you, man.
Thank you.
We can put contributor in the bio for you.
Easily.
Easily. But yeah, man, I'll let you know once my November schedule comes out and we can look. I know things kind of get slow around the holidays, but I'm happy to pop on and do that. In terms of CNBC, I do the show Fast Money. That's on Monday through Thursday, 5 to 6. On Friday, 5 to 5:30. I'm not on every day. I'm usually on about 2 to 3 times a week. This week I'll be on Wednesday and Friday for the entire show. I did just the options action segment today. In terms of social media, and I'll admit, like, I'm not the biggest social media person. I had to have some people manage that stuff for me. At Bonawyn, just my first name. At Bonawyn, Bonawyn. Instagram, Twitter, LinkedIn. It's all there. I have one of those names where nobody else wants it, I guess.
Nah, I appreciate it. Earn Your Leisure, big week for us. Shout out to Killer Mike. We got Killer Mike tomorrow, just to remind you guys. He said when we met Killer Mike, he said he found us on Instagram and he thought we was a 90s R&B group. He was like, who's these light-skinned cats talking about finance? So this what do they call it? Quintet? Like when it's four people, this is like the Supremes or something. Like this is crazy. Like I'm reading the YouTube comments. There's a lot of beige rage comments and things of that nature in there.
You guys are funny in YouTube.
Yeah. So
4 tops right now.
Yeah.
Boys to Men, Jagged Edge.
Yeah,
112.
Sure. But yeah, make sure you check that episode out tomorrow, 5 o'clock, live on YouTube and on all audio platforms. And Wednesday we're back with Chris Senegal,
the legend.
The legend himself, how to buy back the block. That's 8 o'clock on Wednesday. We're taking over this whole week.
Somebody said Josie.
We're taking over this whole week right now. So we appreciate all you guys. I'm gonna give the last word to Ian. Oh, you want to say something before Ian?
Yeah, I'm looking at his numbers, man. Let's run Bonawyn's numbers up. He's almost at 2,000 people following him, man. Let's run this guy's numbers up. Let's get them numbers up.
CNBC ain't do that.
They can't do that for you, but we can.
But also CNBC and NBC Universal family.
Yeah, I mean, please, man, don't get me messed up. But like I said, I mean, that's testament to you guys' brand. That's just incredible, man. That's what it's about. And I know a lot of people get up and be like, yo, I believe in giving back, this, that, and the third. But man, y'all put in boot to road. Hats off to them.
Appreciate you.
Appreciate it,
brother.
Yeah. You know what I would like to encourage people to do? I would like people to encourage. It is the holiday season. Obviously, we know Thanksgiving is approaching. And I'm doing this with a couple of schools right now, but just donating money to families in need. Because right now is a tough time. Obviously, we know with the economy, we're talking about it, but there are a lot of people that are in need. So even if it's the school in your neighborhood, you don't have kids that go there, reach out to the principal, see if there's families in need and see if you can donate anything. Money would probably be the best, or gift cards. Obviously, with Corona, having a can drive is probably not the most optimal thing to do right now. So, and I encourage anybody to do that, or find a family that's in your neighborhood that could use to find some funds or something just to help them along this holiday season. So please, I encourage people to do that.
That's a fact. Ian, give you the last word, good brother.
I've had the word all night, so I appreciate you. Call someone that you love after this. For everyone who's asking about the program, if you go to the link in my bio, I'll put it in there. It'll be free. You can put in your name and email and get signed up there. But Troy Rashad, thank you for allowing me the platform. Bonawyn, my brother, I've been following you for a long time, and I had a blast tonight. Thank you for being on.
Likewise,
thank you for
man.
sharing your expertise, because there's not many brothers in the industry that are willing to share the information. So from the bottom of my heart, thank you for coming on the platform and sharing your insight with us tonight, man. You're amazing.
Hey, Bonawyn, breaking news alert. They got you to 2,000 right now. Let's see what we're going to end by the end of the night.
Those numbers are going to be crazy tonight.
They said he had 2,000 already, Troy. So
run it up. All right, ladies and gentlemen. Thank you guys for rocking with us. We will see you next week. Tell a friend to tell a friend.
We'll see Wednesday.
I'm talking about Market Monday. We're going to see him tomorrow. Yeah. But remember, the podcast will be on all audio outlets at 12 o'clock midnight Eastern Standard Time. So subscribe to Apple, Spotify, and leave a comment, rate.
Yeah.
And then if you missed any part of this, it'll be available on YouTube. The playback will be available on YouTube within like 40 minutes, something like that. So, all right.
This is one of them that you're probably gonna have to listen to
A
and
few
watch
times.
again.
A couple of times. And next week I won't be all in the video with all the questions.
Hey, yo, Ian,
It'll be more
wave.
balanced.
Do the CNBC wave again.
So all
y'all
my
gonna,
NBC
y'all
Universal
gonna
family.
stop playing me.
No, like kudos to everybody at CNBC, NBC Universal. Yeah. Love you guys for real.
Oh, we love y'all, man. We'll see y'all. Peace.
All right.
Appreciate y'all, man.
Peace. Thank you, man.